Right. Hello, hello. I'm going to drive the camera people in the back crazy because I'm going to move around. But we're live streaming this actually, which means you can watch, if you something you miss or something, you can watch the archives on MoneyShow.com. And wow, welcome. Thank you. Thank you so much. This is my annual pilgrimage to Toronto, which I love, but unfortunately this weekend there's a film festival. There was last year, but I was able to get a hotel. This year, nothing. Film is big this year. Anyway, how's it going? How's the show? All right. Is this the last event? The highlight, best, last.
Who gets the car?
Who gets the car? That'd be cool one time, wouldn't it? A lot of questions. All right, well, I am so excited. I actually really am. I've been looking forward to this. I haven't been to Canada in the last year, and although I would just say that like a ridiculous amount of my time is spent figuring out how to get to Canada. I mean, run our business in Canada. It's crazy. You know, this country is run by like basically 5 banks. It is a tough nut to crack. I hate the fact that it's run by 5 banks, but I guess it could be worse. Trump could be your president. We could be in Florida today, too. There's a group of students over here. I went out to lunch with them from the University of Central Florida. Hey, boys. And it's funny, they came up here to actually go to the Money Show, not to avoid the hurricane or anything like that. And I'm like, you see, timing is perfect. You know, somebody was looking out for you. Anyway, it's amazing to be here today. And these are incredible opportunities for someone like me because I get to talk about stuff that I don't get to talk about every single day. Every day we're focused on kind of heavy, you know, our show does 8 hours a day of live content. And I focus on so much heavy stuff with respect to strategies and quantitative analysis and all this research that we do. But when I do a live show, I'm not encumbered. I don't have to worry about Tony interrupting me. I don't have to worry about, you know, Beth telling me not to go there. I can say anything I want. I can do anything I want. I can cover any topics. So I like to go way more general and talk about kind of big picture stuff and just talk about, you know, everything from business to entrepreneurship to life. Tonight's focus is on wealth creation, and I think it's a really fun discussion, and I've only done parts of it one other time because I just wrote it. So it should be fun. It's about 1 hour and 15 minutes. So hopefully that's well within everybody's time frame, all right? So yesterday I decided I was going to go get LASIK done. I've been waiting for I've been losing my eyesight, not really losing my eyesight, but my eyesight's been getting worse, you know, over the last, 10 years. Sit in front of a screen for 30 years, this is what happens. You know, somebody said, why is your eyesight getting worse? Well, in guys, first it's the eyes, then it's the schmeckle, and then it's, you know, that's how life works. But, not a lot of choosing here, huh? Okay. So my eyes are getting worse. I figured, you know, eventually I'm going to go get LASIK. But they kept saying you can't really get LASIK if, you know, for close distances and stuff like that. So we had a guy on the show for bootstrapping, and he was like, this is what he does, laser surgery and things like that. So he said to me, yeah, sure, we'll do something for your eyes. We'll make them better. And I'm like, well, I don't know. This is the first person I ever met that's right next to me that's kind of saying, he seemed confident. His hands were a little shaky, but he seemed confident. So yesterday I figured, so then everybody in my office tells me, well, you can't do this the day before you're going away because you can't get on a plane because your eyes will pop out. You can't get on a plane because your eyes will be too watery, too dry. Everybody had a different reason. But I'm like, screw it, I think you'll be fine. So I go to do it yesterday, and it's pretty much, it takes about 15 seconds on each eye, 30 seconds, whatever it is. And they lie you down and they pull your eye back. I don't really know what they do, and then they bring this big machine over your eye, and then they start to, you can kind of see the laser above you, and then you don't really know what it's doing, but you just hope you're not blind. Everything was cool until the doctor / surgeon, whatever they call him, said, shit. Like, you never want to hear your pilot say shit. And you never want to hear the guy who's operating, because it goes dark for about like 10 seconds, and you never really want to hear that because you're like, that can't be good. So I'm wide awake. I didn't even take a Valium. I didn't care, and because there's no pain or anything. So I'm like, what? And he's like, no, nothing. So I got partially. So in the end, I got it partially done. One eye, he said, perfect. The other eye, not so good. Come back in a month. Eat a couple apples. Come back in a month. So anyway, that was my big adventure yesterday. So I was all worried because when I got home, everything was like really fuzzy, and I was like, oh my God, if I send Tony to Canada tomorrow, you guys are going to kill me. Because I would have killed me for that. But it all cleared up in like 2 hours, and so now it's awesome. And you know what? I've said this before. Flying into Billy Bishop, you guys are lucky. I don't know how many places you can fly from that little airport downtown, but that is incredible. That is really the easiest. I think I don't know what that airport is rated among like world airports or something, but that's the easiest airport to fly into. So, cool. All right, so y'all ready for some? So we've been doing this fun thing at work recently. I shouldn't say recently. I grew up in the industry. This is my 30-something year, 36th year or something. And when I first got in the business, I was like 23 years old. And one of the guys that I was in this S&P pit when they first started trading on the floor. It was like my second year in the entire business. And I meet this guy that's standing next to me. And he still works with me today. It's my buddy Jules. And he was this big guy and weighed about 300 pounds. And he's standing next to me and he's drenched in sweat. And I'm kind of watching him trade because I was learning a little bit about trading myself. And we've been friends for, I guess now, for probably 35 years. But after about 15 years of trading, or maybe even less, probably 10 years of trading, after the 87, so actually it was less than that, it was probably less than 10 years, he turned to me one day and he goes, you know what, I hate this business. And it wasn't for him. He really didn't like the business. It wasn't fun for him. He goes, I'm going to go to LA and I'm going to write screenplays. So I'm like, you write? I don't even have many friends that can write. So I'm like, you write? He's like, yeah, sure. He goes, I want to write screenplays. I want to go to LA, blah, blah, blah. So he packed up his car one day and he goes to LA. What LA did to him, and I hope this doesn't happen to my son who now lives in LA, what LA did to him is it softened him up a little. He became really sensitive. So about 6 years ago, he called me up, he said, my kids live in Chicago, I want to come back to Chicago, can I work with you guys? And I'm like, sure, we'll find something for you. We let him produce our bootstrapping segment and find bootstrappers and everything else. So we said, come on back and you can produce this whole segment for us and you'll learn how to do it and it'll be fine and you'll find guests for us and you'll do whatever. And because he's one of my oldest friends. So he's like, cool, done. I'll take the job and we'll see what happens. So when he came back though, he's a different Jules. He's a sensitive Jules. And yeah, so if you've been around traders for a while, we don't have any sensitive people. Tony's not sensitive. Liz and Jenny are brutal, and you think they're nice, but they're brutal. And then you go through the list and everybody's tough. So we had to come up with a safe word for Jules, because every time when the conversation gets a little nasty and everybody's picking on everybody else and he gets all sensitive, we have to say Omaha. And what that does is, that means whatever you just said, it's a safe word, so whatever you just said, it kind of lets you off the hook. You go back to square one. It's immediately like, oh, I didn't mean it, Omaha, back to square one. Okay? So when I'm doing live shows, I tend to say lots of things that are a little insensitive. So I was trying to come up with a safe word I've never done this before. So I was trying to come up with a safe word for tonight's show. So like if I curse or something, then I can say a safe word. So what should I come up with as a safe word? So I was thinking about this. This was consumed me the whole ride up here on the flight this morning, because I can't use what I used for him, so I had to come up with a safe word. So I figured with all the acts of God going on right now around the world and everything that's crazy, politically and everything, I figured my safe word is going to be Donald. I can only do this in Canada. I couldn't resist, okay? Can't do this in America because half my audience is on one side of the fence and the other half's on the other side of the fence. Canada, it's easy. So that'd be my safe word for tonight. So, again, it's about an hour and 15 minutes, my whole discussion. It's fairly aggressive. I'm going to hang around afterwards because I don't have I'm taking a flight home later tonight, but I have plenty of time, so if you want to ask any questions later on, or, no topics ever off limits with us. It's one of the cool things about what we do. Nothing's ever off limits. You can ask about anything, and after the show, I'll hang around, and if you want to, ask any question. I think, and this is something that's really important to me, I think the couple of minutes that we get to spend, whether it's 30 seconds answering a question, whether it's shaking a hand, whether it's taking a picture, or whether it's asking kind of a difficult question about trading or whatever else it is, I think it's really important. I learn a ton in those crazy 2 minutes. And sometimes you guys learn a ton and it gives you a certain level of confidence. And there's been plenty of situations in my life when I've had an opportunity to sit down, ask somebody a couple of questions, and it's really made a difference in my life too. So anybody that wants to ask anything you want or touch on any topic, I am more than welcome afterwards. So I'm starting off tonight with a discussion of let's make wealth creation simple. And the difficult thing has always been, and this doesn't matter where you are. I tried to make this conversation tonight, or this whole discussion tonight, about doesn't matter where you are, doesn't matter what market you're trading. I don't care if you're trading in Canadian markets, I don't care if you're trading in US markets. I am product indifferent, so I don't care if it's stock, options, futures, real estate, whatever it is. I think that the industry, by its nature, has gone out of its way to make building wealth a very confusing topic for most people. I don't think it is. I think building wealth has a lot to do with your ability, as you're going to hear tonight. It's all about your own ability to take decisions, to make decisions, and to take risk. And I think what we've done is we've essentially tried to change that culture over the years. We've become a very passive society. And we've tried to make wealth creation very complicated. And the reason that we've tried to make it complicated, when I say we, I'm talking about all of financial services, all regulators, and everybody else. We've tried to make it complicated because, one, it pushes the liability onto somebody else, and two, it doesn't conflict with the financial service model. You're talking about a multi-trillion-dollar model that makes its money by convincing everybody that wealth creation is very complicated, and in order to service that or satisfy those complications and that difficulty and all the complexity, it must be something that you don't understand. So individual investors shouldn't try to do it alone. Now, what's so cool about this, on the one hand, is that there's 400 or 500 people here in the room tonight that can appreciate that. What's scary about it is, in one of the largest cities, and this happens everywhere, not just in Toronto, but every city, there's only 400 or 500 people in the room. And when you start to think about that, you're like, yeah, that's so weird. I just did a show in San Francisco 2 weeks ago, and in San Francisco, I said the exact same thing. There's 500 people in this room tonight, but we're in downtown San Francisco. And when you start to think about it, there's going to be 500 people online tomorrow to buy salmon at the farmer's market, fresh sliced salmon at the farmer's market. The line's about 500 people long. And there's 500 people in this room tonight talking about wealth creation, which is something that I think is life-changing. And yet, when we look at it, it's because we've convinced ourselves, and the industry has convinced us, that it's too complex. And why are they doing that? One, it's because of lack of know-how. But two, because if it was so easy, then what's their model? And so the first thing I think, and this is what's so important to me, and this is why I do this, Remember, this is not something we get paid to do or anything like that. This is something I do totally 100% for the love of the game. And the reason it's so important is because once you understand the fundamental argument about, or discussion about wealth creation, then you can explain it to anybody. It's too hard to tap somebody on the shoulder, to stand at a water cooler, for whatever that means anymore, or to talk to one of your kids or one of your neighbors or one of your parents or whatever it is and talk about finance and wealth creation. You can't talk about things like, in general, about, hey, here's a great option strategy you should try, if the person doesn't understand what taking risk is. You can't talk about, hey, you know what, I think it's time to short XYZ stock, if you don't even understand anything about finance. But all of a sudden, you can talk about kind of the values of wealth creation if it just applies to making decisions and taking risk. So what I do, and which I think is really important because it gives you the ability to articulate something that very few people can articulate, and when you can articulate something that very few other people can articulate, you end up in a situation which is very advantageous to you in all aspects of life. Whether it's business, whether it's trading, whether it's investing, whether it's entrepreneurship, whether it's school, it doesn't make any difference. If you have that ability to be able to articulate something that you're passionate about, then you have a distinct advantage over everybody else. We've interviewed 15, or at this point, almost 1,700 bootstrappers. That means people that have started their own business in the last 6 years on Tasty Trade. And through that process, about 85% of them are no longer in business. And the reason 85% of them are no longer in business is, and I believe this, is not because they didn't have a good idea, not because they were undercapitalized, it's because they couldn't articulate their vision. And when you can't articulate your vision, you can't make decisions. And when you can't make decisions, you can't be successful. Wealth creation, I think, is a relatively simple concept that we have complicated and we have made it far more complex than it needs to be. And again, that's because of inherent conflicts in the nature of the financial service business and because of inherent conflicts with respect to academia, which is also at fault, as well as big financial service companies with a lack of know-how, as well as just a general, we have a different appetite for risk. Today's generation, today's younger people have a different appetite for risk than we might have had when we were, between, 18 and 25 or 18 and 35, whatever it is. So that's my goal for tonight. So speculation, risk, and two-sided activity are good because it normalizes fear. That's bad English and a really important saying. I believe that speculation / risk / two-sided activity. What's two-sided activity? Two-sided activity means you have the ability to participate. And it's so valuable because ultimately that teaches you how to normalize, that normalizes fear. The problem with one-sided activity is there's no way to normalize it. The problem without learning how to speculate and without learning how to take risk, you're always fearful of every decision. I know it gets so simple. We used to say crazy things like, if you can order a pizza, you can make a trade. Or if you can order a pizza, you can order a hot dog, you can do whatever, you can participate. But the reality is, speculation, we don't teach it. We teach everything but. We teach the opposite to everybody. We never talk about speculation as being positive. All we talk about is speculation being wrong. We don't talk about risk being positive. We talk about risk is wrong. But think about the most successful people. All they do is take risk. Think about success. And think about people that you know that have built successful businesses, that have built successful careers. And it doesn't have to be about money. Success can be about a lot of other things other than money. But just think about success. And then think about how those people participated in speculation, how those people participated in risk, and how there's usually a two-sided market, meaning that there's something that transacts or some way to participate in that. I love and I'm going to get into this a little bit later, and we'll talk about free markets and free cash flow, but it's very important for me that I think over the last couple of decades, we have changed from a society, from a consumer culture that kind of embraced risk to a culture that, risk is kind of like, where are we going to go to dinner tonight and what are we going to do if it's a bad choice? As opposed to, what if we take 10% of our capital or 20% of our capital and do this or that? What if we take, 50% of capital? I always tell the story when we built Thinkorswim 17 years ago, when we first built it, when Scott and I put it together, we risked 100% of what we had made in the prior 20 years. We didn't even blink at it either. We didn't even tell our families, we didn't blink. It was really important for us to do it. We felt it was a calculated risk. Maybe that was too much risk. But life, I think, comes down, the difference between, real wealth creation and real success comes down to a bunch of decisions that you make over the course of your life. And if you have the opportunity to make more and more decisions, you have the opportunity to be right a lot more than you're wrong. People that take risk, as long as that risk is calculated with respect to kind of pot odds. What I mean by that is, if you're about to take risk, you don't want to take risk when you're risking 1 to make 5, because the odds are against you. But what if you think it's like a 50-50 shot, but you can make 2 and only risk 1? Like somebody said to me today, we were talking outside, and they said, what do you think about Tesla here, the stock? And I own a Tesla, and I really like it. It's a great car. But I think the risk in Tesla is like 4 times as great to the downside as the upside. So if I'm going to buy the stock at or trade the stock at $350, I'd rather be short it because I think it has a better chance of going down 40 than up 10. Now, I don't know anything. That's just how my mind works. Where is the best opportunity? Somebody said the same thing about Amazon. They said, what do you think about Amazon? At $975 or $970, wherever it is right now. And I'm like, I think the same thing. It's not that I think Amazon's a bad company, but if I was to bet here, where is the greatest degree of risk? I think for every $1 you can make to the upside, there's $2 of risk to the downside. Now, is that a reason to short a stock? I think so. Isn't that what the game's about? It's not because you don't know what's going to happen. But anyway, we're in, and that's what we call a two-sided market. That's where you can take two-sided risk. But to me, one of the most important things that we miss out, and you can think about this from just think about academia for a second, and then think about just everything else with respect to risk and two-sided markets. We don't teach it anywhere. Nowhere in life do people get to really make risk decisions. Something we miss out on. It's a little sad. So I'm a fan of, I believe in teaching confidence. Now, confidence doesn't mean cockiness. Confidence means, you know what? I'm going to make a decision, and we're just going to live with it. There's a buddy of mine in Chicago that I may have talked about before, but he's built $4 billion companies. When I say buddy, we don't go out to dinner together and chat on the telephone. We've invested in a couple companies together. He's built 4, and he's on his way to building his 5th billion-dollar company. He's 45 years old. He's the quickest decision maker I've ever seen. He has confidence that's bouncing. He's not an egomaniac. He's not crazy. He just has confidence in every decision that he makes. And I'm like, that's pretty cool. I told him, I love the way you make decisions. He goes, well, I have a rule. Anything that takes me longer than about 15 seconds, then I usually just back off. If I can't decide yes in 15 seconds, I'm usually out. And I'm like, you make a lot of bad decisions, don't you? And he goes, yeah. I make a ton of bad decisions, but obviously I've made more good decisions than bad decisions. And when you think about some of the most successful people that you've ever had, his success is different than the money side of it. His success is because I'm just impressed by somebody that can build 4 different businesses in 4 different industries, all worth over $1 billion, and think about how do you do that by the time you're 45 years old? It's all about his decision making. I'm going to do a documentary in probably the next 6 months about this one person's decision making because it's incredible. It's off the wall. It's confidence. And we don't really teach confidence. We teach about patience. We teach about trying to have certainty around decisions. We talk about don't make those questionable, don't take that questionable risk. I think it's all about confidence. When people have talked to us about over the years about, how do you build successful businesses? How have you done it over the years? I've been doing this now, like I said, 36, almost 37 years. How do you have the confidence to keep doing it? We started a brokerage firm. We didn't know anything about brokerage. We started a media company. We didn't know anything about media. We started, prop trading business. We didn't know anything about prop trading. How do you do it? And I'm like, I don't know. You don't think about it. You just kind of put your head down, and you have the confidence in yourself that you can pull anything off. I think we should teach confidence. It's something that kind of blows me away that we're not confident decision makers. Now, everybody here in this room, you are. This is a different breed. So I'm talking in general terms, but I'm talking in general terms so that you can articulate this and explain this to somebody else. So we have a tendency to think about success and to push it over to the side of luck. So I wrote on here that luck is not the answer. 70% of all lottery tickets, all lottery winners lose it all. I think the statistic is actually greater, but I Googled what percent of lottery winners, keep it all or keep some money. And they said, or lose it all. And they said 70%, less than 25% keep some money, and 5% they are unaccounted for. So 70% of lottery winners lose it all. Think about how crazy that is. So somebody goes, wow, you're so lucky. You won $1,000, $100,000, $1 million, $100 million, whatever it is. And yet, most lose it all because luck isn't really the answer. And then we go on and talk about investing, passive investing, which drives me out of my mind. I don't think it's the answer either. And I wrote on here that 95% of the profits gained in 1987, in 2000, and 2007 were given back in the next down move right after that. So again, you know what? Is luck just being in is having the right investment time frame? Is being involved in the markets during the right duration? So that's the thing that's always driven me crazy about passive investing. And just think of where we are right now. We are in a marketplace where we are almost 99.9% of all capital is passively invested. Whether it's in ETFs, mutual funds, annuities, whatever it is, we are passively invested in the market, and much of it is in the same, small group of stocks, a few $1 trillion. But when you think about that, and you think about what's happened in past bull markets where we've had complacency at levels that we have right now, when you have markets at kind of rich prices like we have right now, what's happened, afterwards? Most people have given it back. And it is very difficult once you make money and then give it back to get back involved. But when you think about it for a second, you know what? If you make money, if you do something and you make money on it, and just because you made an investment, it was a completely passive investment, somebody else made the decisions for you, and it goes up and then it goes down, all you can think of is, I didn't really learn anything. Why did I just do that? What was the thought process behind me doing all that? Why did I put myself through that? Because you didn't make the decision to get in, you can't make the decision to get out, and all you can do is sit there and watch it. That's not investing. That's not wealth creation. That's just being in the right place at the right time. That's the one-hit wonder thing. That's why hedge fund managers that make, $5 billion or whatever it is that they take out of their business for being right. I saw a couple weeks ago that some oil fund, they lost 40 or 50% and they shut down the fund because the guy said, well, oil didn't go up, so we lost money. See, to me, that's not investing. That's not trading. That's not doing something that's statistically valid. That has no pot odds. That's not reducing basis. That's not understanding what you're doing. That's not using the markets. That's not being indifferent about products. That has nothing to do with strategy. That's not taking advantage of opportunity. I think that we've, for years, rewarded luck, and it scares me. So let's stop rewarding luck, and let's start embracing know-how. But very few people have the know-how. How do you embrace something where, who has it? It's crazy, but we're creating a new breed of financial, I'm going to call it financial engineer for lack of a better term, but financial students. And what I mean by that is we're creating a culture of know-how. And it's never been done before in the world of finance. And a culture of know-how starts with some real basics. It's being able to explain why you're doing what you're doing. It's being able to explain your success as well as explain your losses. You can't, if you say to somebody, hey, I bought this stock and it went down, so that's explaining your losses, that's not good enough. But as everybody in this room knows, if you're actively participating in the market and you lose money but do everything right, you're okay with it. It's when you lose money by doing all the wrong things that it really bothers you, because you started to learn what's right and what's wrong. There are certain things you can't control. You can't control which way the underlying moves. So if you do everything right, you sell something in high implied volatility, you sell puts when the market's way oversold, you sell calls when the market's way overbought, you get a little directionally long when the market's oversold, you get directionally short when the market's overbought. You take advantage of opportunities in volatility, you take advantage of opportunities in fear, and all of a sudden the market doesn't do what you want it to do and you lose money, you're fine with it. You don't like it, you're mad at yourself, but you understand it. You can explain it. I managed money for, at one point in my career, I don't do it anymore, but I managed money at one point in my career because that's all I thought was the next step in this business. After I had been trading for about 12 or 13 years on the trading floor, I decided I'm going to start a small money management firm, and we raised actually almost $500 million because we were very successful, and I thought that was the next step in the life cycle or the progression of this industry. What I didn't realize was that every person we were managing money for had no idea what we were doing. All they cared about is if we made money. So what I hated about it was if we didn't make money, we had to explain why we didn't make money, but nobody understood the explanation except for, well, you didn't make money. So I mean, like, I could have gone to Vegas with the money. It would have been the exact same thing because I could have explained it the exact same way. Well, I didn't make money. What we're doing now is we're empowering a culture, a consumer culture, that knows exactly why they're successful and knows exactly why they fail in an efficient marketplace. That's never been done before. They couldn't do that in academia. They couldn't do that in investor education. And they could never do it in financial services. What does that mean for the individual investor? Well, you see it today. Way better front-end technology. You got stuff that kills it right now. It's a smoke show, your front-end technology. You have ridiculously low rates. Not yet in Canada. It's coming. We will get here. The rates will be significantly lower in a year. I'm hoping 50 to 75% lower. It will get there. Rates here have to be lower because in order to level the playing field, we did 100,000 plus Monte Carlo simulations of rate structure. Now, I know this is going to freak out any other firms that are here, but we did a ridiculous amount of research on rate structure. We didn't just, at Tastyworks, we didn't just come up with the rates and say, oh, this is just going to piss off all the firms. What we did was we studied all these different combinations of strategies and rates. And we said, where does an individual investor have to be in order to be successful trading and managing their own accounts actively? How much does the retail fee structure have to come down? Now, I'll give you some ideas. The average ticket, which means the average trade size. The average trade size in Canada is very expensive. It's in Canadian dollars, it's still like over $12. It's like $12 or $13, something like that. The average ticket at Tastyworks, for example, is $2 and something, like $2.50. Same size trades. $12 here, $2.50, let's just say here, $2.25 to $2.50 here. It's easy to see why this model does not work and why this model has the opportunity to work. Because you can't overcome, a 5x difference in fees. So we ran this model and we ran it crazy, and we just figured out that we had to lower rates by 75 to 80% throughout the entire industry to change the way retail investors interacted with efficient markets in order for them to be successful. And the answer is, now they can be successful. We had something happen to us in the last couple of months that I've never seen happen before. So here's how the industry works. If you place an order on your front-end platform, whatever platform that is, wherever you are, anywhere in the world, you place an order, your order doesn't go directly to an exchange. And there's a good reason for that, because the exchanges are very inefficient. Your order goes to a liquidity provider, which is somebody that steps right in front of the exchange. The reason we do that as brokerage firms is so that, one, we receive payment for order flow, but two, the customer gets a better fill. It all happens in about 6 or 7 microseconds. The customer gets a better fill because the only way that that order can be filled instead of going down to the exchange, is to be price improved or the same price or better than at the exchange level. So the customer gets a better fill, and the firm gets paid a little bit of money for that happening, and the exchange gets cut out, essentially. Now, that's a good thing, believe it or not. But about a month ago, one of the firms that we were routing orders to fired us. Now, in all the years I've been doing this, I've never seen anybody turn away retail investor business. Remember, the average size order is very small. It's a couple dollars, in fees. So it's a very small order, the average size order. Yet this firm that we were routing, 10, 20, 30,000 orders a day to said, we can't do your business anymore. And we're like, what? Are you firing us? And they go, well, it's not you, it's us type thing. But they said, we can't make any money on your order flow. Now, we almost cried, not because they were firing us, we were happy. We almost cried from happiness because we're like, oh my God, we have finally leveled the playing field. We have finally got a liquidity provider, one of the biggest in the world, to say, you know what, we can't make any money on your order flow. Meaning, if we have to pay you for this order flow, we make nothing. And so therefore, we're just doing it as an accommodation, so we can't take your order flow anymore. Thank you very much. You can go to the next firm. That's never happened in all the years I've been in the business, seen a market-making firm turn away order flow from retail investors trading small orders. That means, and we were so excited about it because that means, one, our high-frequency customer technology is working, and two, our content's working. It's the greatest sign I've ever seen because everybody says, give me everything you've got. Because you can't lose taking the other side. Imagine a casino saying, you know what, you're too good a gambler. It can't happen because the odds are all in their favor. But in this business, it just happened. That's a fascinating accomplishment, and it's a testament to the content, to the technology, and to the rate schedule the customers have now. So, and that will happen in Canada, and that will happen sooner than later because you're going to get a rate schedule that reduces rates eventually by about 75%. Once that happens, the customer is routing orders and the firms are filling orders at the exact same fee structure. They have all the expenses, you have a small fee on top. Everything's equal. And I'll show you in a couple seconds why that's so important. But finally, as individual investors, if you have an inefficient marketplace, so like for example, you're trading real estate, you're trading coins, you're trading, even Bitcoin, whatever it is. If you have an inefficient marketplace, even if you have know-how, you can't make money. Because the inefficiency of the market sucks up whatever strategic edge you have. But if you have a totally efficient marketplace, which global liquidity essentially is and listed markets are, then if you have know-how, again, why aren't there 5,000 people in this room? Because if you have know-how and you combine know-how with opportunity, it's a really interesting. I'm not saying you have an advantage. I'm saying you have a strategic opportunity. And that is extremely rare in anything that's an efficient marketplace. So don't pat yourself on the back for random success because that's the mistake we all make. That's what lottery winners do. They all pat themselves on the back. That's what one-time hedge fund winners do that make $5 billion one year and lose $5 billion the next year. That's what money managers do. Don't pat yourself on the back for getting long and the stock's going up or, when the stocks go down, outperforming because you lost less than the next guy. Don't pat yourself on the back for luck. It's cool. Luck is great. Look, we all want to go win in Vegas. We want to win at the horse races. We want to win anything. We want to be lucky in everything we do. But random success is not something you get, not something you pat yourself on the back for. It's not something you get all puffy-chested about. It just doesn't work that way. You know what? Scalable success. The coolest thing in the world is scalable success. I love it when somebody sends me an email and they said, you know what? I started off and I was trading one lots and I was doing this for the last year and it's really cool and I'm up money and I'm really learned so much. Now I want to go up and I want to scale. How do I scale? Or people come to us and they say, you know what? I built this business. I had a guy come in the office the other day, really successful entrepreneur, nice guy, comes in the office, he sits down and he goes, can I ask you a question? I'm like, sure, what's up? He's like, I don't know how to scale. He goes, I'm nervous about scaling. I feel like if I scale my business, he was in cybersecurity. And he's like, if I scale my business, I'm worried I could blow everything. Because he goes, I've read all these horror stories of people that scale. And I'm like, you know, and I gave him a whole speech on just, well, not a speech, but I just had a discussion with him and said, you've got to learn to scale. It's eventually, you know, you can be comfortable, but you've got to learn to scale. And I think one of the things that we don't do is, first of all, we have a lot of trouble taking risk. We're a very risk-averse society. And then as soon as we learn to take a little bit of risk, then we don't learn how to scale it up at all. One of the things that we do, and that's been very successful for us throughout our entire careers, is we had no problem scaling. And I'm still here. And I say that like, you know, not cocky, not with a big ego, but just, we're still here. And we're not the brightest bulbs. None of us are. We have an incredibly, the level of intelligence of our audiences everywhere is off the charts. But everybody's about the same. We did a show recently in Chicago. There was a couple of people that are in this audience tonight came to it. And it was called Geeks on Parade. And we had all our data scientists and all our smartest models people do a 1-hour lecture each at this thing called Geeks on Parade. We had 1,300 people or something like that, 1,400 people sign up. We had 130 spots, so we did a lottery. And essentially, we said to everybody, whoever comes to this thing, and about 90% flew in from out of town, said whoever comes to this, just be prepared to be challenged because we're not dumbing anything down. And I've challenged our 5 speakers to make this as complicated as it can be. And again, they all have their PhDs in finance and data science and these crazy things in financial math and lots of other crazy stuff. And I said, don't dumb a single thing down. I want everybody to leave here with their head spinning. And you know what freaked me out about it? When the show was over, and it was straight 5 hours, no bullshit in between or anything. When the entire show was over, every single person came up to me, not every single, but every person that stopped to talk to me on the way out, and I was not one of the speakers, said, you know what, Tom? I thought I was going to be blown away and all the content was going to be way over my head, but I got everything. I understood everything. This was the toughest stuff these guys had. This was their 5 years of their PhD program. These were their thesis. This was everything they had put together that nobody understood. I don't think very many hedge fund managers, very many portfolio managers, very many CEOs of financial service companies have the slightest clue what they were talking about. And every single person in that audience was a retail investor, came up and said, piece of cake, or at least I got everything. I understood everything everybody talked about. Nobody said it. It blew me away. And also, it was a really fun show. It was a great show, but it wasn't over my head. That meant we've done something that's really special. We've provided know-how, or we've encouraged. We haven't done it. Everybody's done it on their own. We've encouraged the application of financial know-how, of strategic know-how, of mathematical know-how. I say it all the time. It's just math. And it's crazy, but it gets absorbed because everybody's so damn smart. We've just dumbed everything down for so long. Like we've said, you know what, if you want to retire or do whatever, you've got to buy this idiotic annuity, or you've got to put your money in this loaded fund because they have better managers, or you've got to invest with our analyst or in this real estate fund, or whatever else it is. We've never challenged individual investors to make their own decisions. And it's crazy. So 93%. And I studied this I took this from all these studies I can find about self-made millionaires. 93% of self-made success stories keep their money and grow it. We started this with self-made billionaires. So not the Walton family where wealth is passed down. But, you know, talking about self-made billionaires and then down to self-made millionaires. And we finished and we kind of ran out of room with our back testing. But we looked at as much historical data was out there to see how people that created wealth on their own, that started with absolutely nothing, how have they done compared to lottery winners? So lottery winners were given the wealth. They couldn't hold it. 70% of them blew it all. 93% of self-generated wealth, and I'm talking about significant wealth, kept it all and grew it. Or kept most of it and grew it. There's a reason for that. It's decision-making. It's an understanding. It's know-how. It's the ability to take risk and the ability to know what to do with that money when you make that money. Of course, some people make it and then lose it. It happens all the time. but the majority of it, in this case 93%, and I understand we've been in a bull market for 10 years or whatever, but 93% have kept it. That's an extraordinary figure. That goes to show you that the amount of capital out there that's being generated by people that know how to take risk, know how to make decisions, and know how to use strategies to apply that, and know how to reduce basis and whatever else it is, are able to do that. There's a powerful argument for entrepreneurship. There's a powerful argument for business. And I don't just relate this conversation to trading today. It's about everything. I think it's really important. So this is why brains work and bots are iffy. I had this discussion today at lunch. I had this discussion briefly with a woman that came up to me before the show started. In the world of efficiency, because everybody's so concerned, you read Elon Musk talk about, one of the biggest risks is artificial intelligence and, to the economy, to jobs, things like that. And what about for investing? What about for finance? What about for opportunity? And I believe, and I'm not anti-artificial intelligence or anything like that, but I believe that the power of success is something that we hold in each one of us. It's in our brains. I don't believe if you talk about efficient markets that there's opportunity, that there's robotic opportunity. I believe in quantitative opportunity, which is the ability to be an opportunist, which is the ability to seize an opportunity in a strategy because you've done quantitative work. I do not believe that robots can come in an efficient marketplace and outperform as long as that marketplace is truly random. And I believe that all marketplaces that trade globally are random. So if that's the case, for example, I always use, whatever I'm holding, but this is a clicker. The clicker, let's just say this clicker is worth $5. And so the market on this clicker, if the market on this clicker was $3, $7, and it's worth $5, there is a robotic opportunity. There's an algo opportunity to take advantage of this clicker. You can arb it back and forth. If there is, the market on this clicker is $4.99 to $5.01, there is no robotic advantage. There is no algorithmic advantage. And every single liquid marketplace that you trade is the same exact thing. You're trading $100,000 worth of notional, usually using anywhere between 50 down to 2,000. The amount of capital required to trade leveraged instruments on $100,000 of notional is between 2,000 and 50,000. The most you can pay is 50, the least you can pay is 2. And yet the markets are 1 penny wide around theoretical. If that's the case, there is no robotic opportunity. Robotic opportunity or artificial opportunity comes with inefficiency or discrepancy in the marketplace. It comes with arbitrage opportunities. The reason the firms out there today that are great prop firms or arbitrage firms, they seize opportunity that's not traditional opportunity. Like they're not seizing opportunity because they know that IBM is going to be higher or lower tomorrow. They seize opportunity because they may be able to sell IBM volatility overseas in Japan or in Europe overnight, and they may be able to buy it the next day in the US cheaper, or vice versa. Or they may be able to add liquidity to some market and get paid for it, or take liquidity here. Or they may be able to scale all of your order flow together and figure out a way to profit from it. But they don't make money because they know what's going to happen directionally because markets are random. So again, to give you my example, which I think is so important because people get freaked out, there has to be a reason why 99.9% of investors are passive. How can that be? I mean, I know it's a capitulation of complacency, and I use that term all the time, but how can 99.9% of investors be passive? It's not even possible. We're not passive about anything. Who's passive in their life? I mean, why would anybody be passive? What business do you wake up in the morning and go, wow, I want to invest in this business because they think passively? How do you go through life and say, you know what, I'm just going to be passive this year? We hate that. We don't do it in school. We don't do it at work. We don't do it in our life. We don't do it anywhere. But yet when it comes to investing, we all want to be passive investors. It doesn't make any sense to me. Well, there has to be a reason for it somewhere. And it's because we've created this conflict of knowledge which says you are disadvantaged. The very fact that you want to invest money yourself, you must be disadvantaged. Because otherwise, why wouldn't everybody do it? And again, why wouldn't everybody be here today? Why wouldn't there be 10,000 people here? We should have more people here today than at the Blue Jays game. We still might, but still. It doesn't make any sense to me. And the reason is because people don't think it's fair. But how can it not be fair? If you are trading an illiquid product that is $4, $6, and it's worth $5, there's enough inefficiency for robots to take over. But if you're trading a marketplace that is on $100,000 notional that has 1 penny in give up, it doesn't make any, there's no robotic edge whatsoever. And that's why it used to drive me crazy. That's why the Michael Lewis books, that's why all the discussions about high-frequency trading, that's why all the discussions about reducing liquidity push me over the brink, because it's completely the wrong argument to have. We should be encouraging liquidity, because by encouraging liquidity, we are encouraging activity. By encouraging activity, we are moving away from passive investing. Unfortunately, the only thing that's going to move investors away from passive investing is going to be a large decline in the stock market and a large rally in the, a large decline in the bond market, a large rally in rates. And the reason for that is because that's when people start to freak out. And that's when they say, I can lose money on my own, I don't need you. But that's not the reason to do it. As crazy as this sounds, we need to remove the passive instincts that we have and move into a risk-taking environment, because our brains actually work. And not only do they work better because we have more opportunity than the big firms. If you're managing $10 billion, the places you can go to seek liquidity are really limited. That's why the same firms buy the same 5 or 6 big stocks. That's why everybody owns Apple. That's why everybody owns Amazon. That's why everybody owns Facebook, because there's nothing else to buy with billions of dollars. That's why everybody owns bonds. There's nothing else to buy. But at some point, if individuals take over their own capital, you're going to see a very different marketplace. You're going to see very different opportunity. And I think markets are going to normalize over the next decade. And I think you're going to see a very different kind of opportunistic landscape. And the people that understand risk-taking will have a much greater opportunity to take advantage of that. So I'm still studying. And something I told people out there, it's one thing to say, great, I've been doing this for a long time. I've run into so many people that sell crappy newsletters or crappy investment services or crappy this and that, or crappy money management and everything else, because I've been doing this for 25 years. I've been doing this for 35 years. I've been doing this for forever, since the turn of the century, the 19th century, whatever it is. The reality is, and I didn't think I would have been able to say this, 7 or 8 years ago. We've learned more in the last 3 or 4 years than I learned in the first 33 years in this business. I've learned more in the last year than I've learned in the prior, if we're just going year over year, than learned in the prior 35 years. So the opportunity today is greater than it's ever been. I mean, the opportunity may not be in the markets all today because the markets are very complacent and the volatility is really low. But when you think about it, we have the ability now, the technology is so good, the content is so strong, and your availability, the availability of just things that were never around before, shorten the learning curve now, to a few weeks, a few months. Yes, you need a ton of repetition. Yes, you need a ton of actual trades. Yes, you've got to do something a number of times to make it happen. But forget that 10,000-hour rule. Let's think about it in real terms. We have shortened the time frame dramatically. Whatever it was before, it's a tenth of it now. And what we're learning today is completely different. So not only are we shortening the time frame, we've improved the quality of the material 10,000-fold. So what we're learning today strategically and what we're discussing today technology-wise is nothing like we were doing 10 years ago or 15 years ago or 20 years ago. That's why I hate investor education, because it doesn't work, because it can't evolve. That's why I hate kind of classic academia when it comes to finance, because very few finance professors evolve. There are some, we are changing it. We did a show recently in I believe it was in Washington, D.C. There were as many as 30 finance professors there, including chairheads from Yale, from Georgetown, from I can't remember, from George Washington. They came down from University of Connecticut. We had a crazy group from all these chairheads, all these finance professors, and it was like, you know what? We're changing curriculum because you're right. Because we have to think differently. We have to approach finance very differently if we're going to change the culture going forward, because we have become very risk averse. Why is that? Because, well, you know what? When kids graduate college now, they have a lot of debt. We didn't have a lot of debt. I had $1,200 in debt when I graduated college, and some kids, they have $120,000, $200,000 in debt. It's really hard. I get it. So you want to take risk, you want to think about risk differently. But that's not enough. We just aren't a risk-taking society anymore, and that's scary. But you know what? The studying aspect to it, I never thought that I would retrain myself. None of us did. I never thought we could train Tony, and we did. But there was a trading floor on the Chicago Mercantile Exchange, which I never traded on. But the Chicago Mercantile Exchange had about, at one point, like 25 or 2,800 traders on that floor, all trading different futures products. Because there was edge, because the markets were wide, and because customers were buying offers and selling bids, and they could step in between and feed 2,800 people. Today, with electronic markets, there's like 100 people, or 280 people, let's be more fair. It's a tiny little group of traders. Where did everybody else go, and why aren't they trading off the floor? Because they never learned how to trade, and they never retooled. And it makes total sense. They're all gone. They're never coming back. The money's gone. It's the time for individual investors. What we've done is something really special. We've transitioned a floor mentality, which is an opportunistic mentality, into a real strategic opportunity. So let's talk for a second about the importance of free markets and the importance of free cash flow. One of the things that we underestimate as individuals here is, okay, it's cool to learn something, but when I learn something, I've got to learn how to make money from that. And very few people teach that. One thing is to learn, another thing is to learn how to make money doing that, or learn how to create some kind of wealth from doing that. The other thing is to understand the importance of free markets, because as soon as you understand the importance of free markets, all of life is figured out. I know that sounds so simplistic, but every single thing with respect to business and many of the choices we make are all based on a free market mentality. That's what it is. Should I buy this or should I not buy this? Or should I make this decision or do this? Or should I not do this? Should I take this job or not take this job? Should I go to this school or not go to the school? Should I give this advice to my kids or not? I just had this discussion with my son the other night. He's 25 years old. He's putting together a business proposal for somebody, and he asked me all these questions, and I go, think about it. Just think about it like it's a marketplace. I go, his mind doesn't work like it has this free market mentality. And the first thing I said to him is, where's the cash flow from this? Don't show me a business that may make money later on if you whatever else it is. Show me where the cash flow is. And show me, explain to me the marketplace for this. And I think what's so important and something that's left out of almost everything we do is, since we have avoided the topic of risk and we've gotten away from decision making, which I'll talk about in a second, we've forgotten how free markets work. And we've forgotten about creating, that's why you get an economy like in China right now, which is growing significantly faster than the economies elsewhere in the world. I won't just limit it to the US or to Canada or anywhere else. But it's because it's a new marketplace. It's a new free marketplace. You're getting to experience for the first time. It's like we were in the 80s. It's a little bit different. So for me, decision-making skills are learned through doing. And decision-making skills are the single most important thing we can do. There's a reason I love trading. Because all I do every day is make as many decisions as I can. I mean, I talk all day long and I explain, I talk about different strategies and I explain the research we're doing, but then the entire rest of my day is decision making. And it's not the kind of decision making of, should we build this or should we buy this or should we do this? It's, what trade am I going to make? And it's, how many trades can I make in a day? And I force myself to be active in the marketplace because I want to make as many decisions as I can make, because then you have no fear of anything. No fear. Make 10 decisions a day. Make 20 decisions a day. Make 50 decisions a day. And then the art of decision making, it makes you unstoppable. It really does. Nothing is too great for you. You know, I talked about this when I was here last year. I called it economic bias, and I had a whole discussion on it when I did this talk last year. And I talked about how your mind works differently when you make just a few trades on eBay, and you make a few trades on some kind of, website that allows you to do something where you can buy or sell something. And by making 10 or 20 trades, trading sneakers or baseball cards, all of a sudden you're 100-fold better at making decisions. Well, what if you make 50 trades a day? Or what if you make 20 trades? Or what if you make 50 trades a month? Or what if you make 500 trades a year? What if you make 2,000? Your brain works completely differently. We used to call that churning. You're churning yourself, you're doing whatever else. The regulators have 1,000 names for it. But what nobody ever understood was, oh my God, every single person that has been ridiculously successful has this ability to make all these decisions. Outliers are not outliers because there's very few outliers that are outliers because they just had some unbelievable concept. Almost all outliers have this unique decision-making ability. And we discount it. How do you get there today? What vehicle can you use to make decisions? Think about it. What vehicle? Where do you get to challenge yourself to make decisions? Outside of trading, what can you do? There's not some website you can go to that really challenges yourself, because just the challenge isn't enough. You need an emotional risk, and you need a monetary risk. You have to put dollars on the line. You have to have something at stake. You have to have some kind of risk. There has to be an emotional risk or an emotional attachment to whatever the action is, and there has to be an economic outcome. That's why you can't paper trade and think that that's a decision making. It has to be real. And as soon as it becomes real, all of a sudden you're like, wow, I did this differently than I would have before. And you start to think about things like size of trade. You start to think about things like, when you're going to manage that profit, or when you're going to adjust that loss, or whatever else it is. It's really fascinating how it changes everybody's perception of risk. And then what happens? You can make enough trades that it changes your life. And you can do that with a small, I don't care if you're a college student with $3,000 or you run your own business and you have $3 million. It doesn't make any difference. The amount of actual risk is irrelevant. It's the art of the decision making. So for example, if I trade one contract of something, or if I trade 100 contracts or 500 contracts of something, for me, the emotional outcome is exactly the same. And very few people think that way. And of course, the regulators don't think that way, the industry doesn't think that way, and nobody in the world of finance thinks that way. But nobody really gets how important decision making is. Yet over the last 3 years, kids coming out of school, when I say kids, I mean 22-year-olds, 24-year-olds, 25-year-olds, we've placed, when I say we've, tasty traders, people that have watched the show through their colleges and everything else, at least 100 of them are managing portfolios all over the world right now. All over the world, big portfolios, like billion-dollar portfolios, because they think differently than every other 25-year-old or 24-year-old or 27-year-old. And individual investors all over, whether it's somebody who's 90 or somebody who's 50 or 60 or 30, whatever it is, male, female, it doesn't make any difference. Everybody's thinking differently. Their ability to make decisions is a life-changing thing. Very few people talk about it. We talk about everything else as being life-changing, but we don't ever talk about decision-making and how do you practice decision-making. There's only one way. I mean, I'd love to see somebody point out a different way where you can take emotional risk and monetary risk in an efficient marketplace. There's plenty of ways to do it inefficiently. You can become an addicted gambler. But there's very few ways to do it in an efficient marketplace where you can be opportunistic, where you get to do what you want to do. So I think that trading, let me just check my time. Trading is the ultimate decision-making vehicle is trading. And I've said this for years, and I'm never going to change with this. It's the most important thing, and nobody gets it. And this is my argument when you want to turn to the person, you want to turn to your kids or turn to your parents, whatever it is, and say, why? And somebody says, or your neighbor, and they say, why do you do this? The answer is, it's the ultimate decision-making vehicle. It's changed the way I think. It gives me confidence and purpose. Very few people, when you work for other people, it's very difficult to have the level of purpose that you want to have. And purpose is something that's really important because purpose gives you confidence. And you have to have confidence, purpose, know-how, and you get all that through decision-making. And that's what trading gives you. So I tell this to my kids all the time. Just make 50 trades this month. I don't care what you do. Because it will give you the confidence and it will change your entire professional career. And they're like, you're nuts. What do you know? But then again, they usually come back to me 2 or 3 years from now and say, oh yeah, that was a pretty good idea. It's something that, again, very few people talk about trading. People talk about trading because you're supposed to know what's going to happen next. I believe markets are random. Nobody has any clue what's going to happen next. So if you have no clue what's going to happen next, then why are you doing this? You're doing this because you get to do what you want to do. You get to make decisions. You get to build your know-how. You get to create purpose. You get to understand opportunity. You get to understand strategy. You become a much different thinker. Your mind works logically. You become a much better, you're a stronger debater. You can argue with people. You can articulate discussions on topics that you never would have touched before. Because you can talk about free markets. You can talk about, everything that relates to kind of the real world. Changes everything. So the way we stay consistent is to be contrarians. Now, I'm not suggesting that everybody should be a contrarian. Some people don't like being contrarian. So don't. The way for me to stay consistent is to be a contrarian because that allows me to always be on the opposite side of the way everybody else is thinking. Now, there's nothing that says that being a contrarian is better than kind of following the crowds, except there's nothing statistically to support that if you believe in real random markets. But I find what it does is it gives me consistency so I don't go from one side to the other side. So I'm not constantly trying to play both sides of the fence. So I think being a contrarian for me is really important. Now, because people ask all the time, why are you contrarian? It's such a torturous life to be a contrarian. It's like betting the don't at a craps table. But for me, it gives me consistency, and that's something that most people seek, and it's really hard to find. So I look at this as if we stand alone. And I think that that's really important. And I know you've heard this a million times, buy low, sell high, do the opposite of what all the crowds are doing. It's so easy to say, nobody does it. Nobody does it. They find it almost impossible to do. I do it every single day of my life. I stand alone. Now, people will hate you for that. Spouses, kids, family, things like that. But because you're always kind of on the other side. But the reality of it is, just from an investor standpoint, you just don't want to be public. Just stand alone. Try it for a little bit. Because you cannot buy wealth. You can't buy rich. It's something that's learned. It's something that is achieved through the challenge. It's something that's achieved, obviously, through hard work, obviously through lots of things. You bust your butt, there's a good chance you're going to be successful. But you need more than that. But no matter what it is, you can't buy your way. You can't say, hey, here's $10,000, go make me rich. You cannot buy rich. And people have a tendency to believe, based on somebody else's track record, that you can buy rich. It doesn't work that way. Yeah, there's a few people that got to invest with Mark Zuckerberg or Elon Musk or somebody like that when they first started out. But for those few people, there's 7 billion other cases where you lost everything. I've been investing on my own as an angel investor for 35 years almost, since my second year in the business when I made money. I've never cashed a check. And I've been investing in small businesses just because somebody backed me one day and I figured, well, you know what? I'm going to do this. I figured somewhere along the line I'm going to hit one. I've never cashed a check in 35 years. I can't even tell you how much money it is that I've given or written checks for, and I still do it to this day, and I don't have any idea why, but it keeps me grounded because I realize, oh my God, I vetted each one of these deals, even though I vetted them not I vetted them in my own crazy way, so it wasn't really that deep. But I vetted them. I made the decision. Nobody twisted my arm, and I've never cashed a check. It's not easy. It is not easy to decide what company, what you should invest in, or it's really hard. So for me, you can't buy rich, and the idea, so let's stop thinking that way. If you make an investment, it works out someday, you're like, okay, that's cool, that's great. I've never bought a piece of real estate that actually is appreciated. My house today is worth half of what I paid for it. In the biggest bull market ever in real estate, I lost half. It's crazy, but I don't care because that's not where I've created my own wealth. But I guess my point is that people think that you can make a smart investment because you can bet on somebody else doing something. And you can't buy rich. It's not possible. So I want to focus on this as I wrap this up. Being passive is destructive to wealth creation. It's kind of what I live by. It's something that I want to fight until I can't do this anymore. I do not like the entire concept of being passive. You never get to make a decision. You don't understand why you made or lost money. You don't develop know-how. You don't develop decision-making skills. And yet everybody promotes passive index investing because they say it's the only way to accumulate wealth. It's insane to me. And nobody gives the counter-argument, and nobody will give a counter-argument until the market eventually goes down. Then you hear everybody go active over passive and everything else. But right now, that's all you hear and that's all you've heard for decades. And it doesn't help when the Warren Buffetts of the world and everybody else becomes the richest people ever from being passive. But you know what? When you think about it, Buffett's created most of his wealth. I think like 90% of his wealth since like 2004 or something. So it's been that recent market of the last 13 or 14 years. But it doesn't matter. Being passive at any age, we talked about kind of nobody wants to be passive about anything, but I think passive investing is worse than you want to do it. I think it's destructive to your long-term wealth. So successful businesses are built around an intellectual challenge. And when I say successful businesses, I mean trading, I mean anything you do in life, anything you do as an entrepreneur, anything else. You want to be successful, create an intellectual challenge. Think of the last place outside of something that we've done or something that you've been challenged in the markets or something. Think of the last intellectual challenge that you had. Outside of a test or school or something, think about intellectual challenges that you took on your own. Maybe the New York Times crossword puzzle. I don't know what it is. What's the last intellectual challenge that you set yourself up for? And you know what most people do? They freak out over this question. They go, I don't know. I can't even remember the last time I challenged myself on something. The last time I went to something where I said, you know what? I just want to be challenged by the content. The last time they did something with their own money and said, I want to be challenged by the content or by the opportunity. How many opportunities have we faced in life? The next thing you know, you wake up and you're 50, 60, 70, whatever it is, and you're like, damn, I did a lot of things in my life, but I never challenged myself. I never took that risk. Think about that. When was the last time that you thought about being challenged, an intellectual challenge? That's what I love about what we do, is I can have a conversation one-on-one with everybody in this room, and we can talk about intellectual challenges. We can talk about strategic challenges. We can talk about quantitative challenges. Who the hell does that? It doesn't happen anywhere. It's so cool. So this is kind of what this is how we think about business and life, and it's so weird that this thing is up here, this comment's up here today, because, I was talking about excessive fear, and then you have all these crazy hurricanes and all these things going on, and you start to think, how's that play in? And somebody that stays behind and no damage to their house, they're going to go, yeah, it's all about excessive fear, and then somebody else is going to say, yeah, that didn't work so well. And so, but we believe that fear, one of the keys to success is that most people really get scared of stuff. And so fear becomes really overpriced because there is no context around fear. You can't define the outlier that fear could become. You can't define the 3, 4, or 23 standard deviation move. You can't define tail risk. And because you can't define tail risk, fear has to be overpriced. And therefore, we believe that capitalism, in its purest sense, which we all are, it thrives on excessive fear. What that means is it thrives on the opportunities created by excessive fear. So if something gets really expensive, it needs to be sold. If something gets really cheap, it needs to be bought. If the volatility around something or the expected move around something gets really expensive, it needs to be sold. That's excessive fear. Because fear cannot be underpriced, but it can be undervalued relative to historical norms, but it can't be underpriced because it always has unlimited risk. It's log normal. So when we look at markets and we look at opportunity, we have to think about it as, wow, where's my true strategic opportunity? It's in overpriced fear. For example, right now, the single most liquid stock in the US markets is Apple. The stock with the second highest implied volatility rank is Apple because they're launching a new iPhone. So you have the most liquid stock with the highest implied volatility rank right now. So putting context around Apple, it has the most uncertainty or the most fear wrapped around its current stock price and its current derivative prices of any stock, and it's the single most liquid stock. That's an opportunity. Not an opportunity to buy it or sell it unless you have a strong directional opinion, but it's an opportunity to sell excessive fear in there. And that's the kind of thing, that's what we talk about as opportunity. Now, if it doesn't work, it doesn't work. But you made your best guess. You have the potential for volatility contraction, which exceeds the potential for volatility expansion. Therefore, your $1 at risk with an 80% probability of success is way better than the 20% side on the other side with unlimited risk. And that's how we view the markets. And that's how we look at what we do every single day. And that's how we look at that intellectual challenge and assign both emotional risk to it and hopefully a positive monetary outcome. All we have to do in Canada is get you to lower rate structure so that you can afford to do that every single day, 50 times a day. So, I think that's my full hour and 15 minutes. Is it? Just about, yeah, or a little over. But I know that's a little heavy for a Saturday afternoon. But I do this on purpose because I feel like it's so important when we have an opportunity to kind of fire up the troops and get everybody excited about thinking about, you know what, it's my time. I didn't start Thinkorswim till I was in my 40s. I didn't start Tasty Trade till I was in my 50s. And I started this business in my early 20s. There is a ridiculous amount of opportunity for the 20-year-olds we have in here, the 30-year-olds, 40s, 50s, and everybody on up. It doesn't make a difference. And so I just want to encourage everybody, you live in a land of opportunity. Take it. Thanks so much.